Hello, this is John Burford, and in this brief video I'm going to cover the subject of momentum and how I use it in my trading. Okay, momentum, what actually is it? Well, it is one of the most basic of all technical indicators, and it appears on pretty much all spread betting platforms. And in this video I'll briefly describe what it actually measures, and then give you a very simple but extremely effective way to use momentum to give you solid clues for approaching changes of trend. That's very important. I like to do that in my trading. I like trend changes because that gives you the most potential for large gains. Now, if you combine momentum with some of the other methods I've described in the other video tutorials, I have a very formidable methodology for entering trades at low risk and also a means of exiting profitable trades. Now, the latter point is where many traders have a great deal of difficulty exiting a trade, and this is one technique that could possibly help you. Okay, so what is momentum? What do we measure by that? It's actually a measure of the strength of a trend, either up or down. Now, a market with high momentum will be rising very rapidly. And of course, in reverse, a very low momentum reading will mirror a very rapidly falling market. Now, to measure momentum, all we do is take a series of successive time periods, and at its simplest, let's take daily periods and look at those daily market closes. Now, a good number of days to choose is 12, and this is the default period chosen by many spread betting platforms. We could choose a larger number, but this would mean the momentum would change too sluggishly to be of any use for pinpointing trading entries or exits. And if we choose a period less than 12, the momentum will dart all over the place and be of absolutely no use to us whatsoever. And it appears that 12 is a good compromise. Now, the momentum value is simply the average close over that 12-day period. Now, move this period forward one day and do the same calculation for those 12 days, and we get a new momentum value. And if we keep doing this every day in succession, we find the momentum value follows the familiar wavy line on the chart. Here it is here on the Dow. Now, we can do this for any time period whatsoever. Let's just this is the 2-hourly period. We could go down to the 3-minute period, and we get a momentum reading every 3 minutes. You see the Dow is against all indicators rising very rapidly here. Let's go back here. Anyway, here's the chart I'd like to show you. Let's go back to this period here. It's quite a choppy period, the August-September period. We've got quite a few examples here of how I use momentum. Now, of course, luckily, the software does all these calculations for us. Now, you'll notice that the momentum scale here has a series of values. I must confess, I have absolutely no idea what those mean. And in actual fact, it doesn't really matter, because I'm looking for patterns, and I'll show you this a little bit later on. Okay, as I mentioned, the 12-day period, or the 12 period, works for me, and I suggest you stick to that one, because I believe in simplicity above all else. Okay, here's an example here. Here we have a rapidly rising market from this low here. To choose an example, we've come off from this low momentum reading, and right away this snap up has produced a very large snapback in the momentum. That's to be expected. That's fine. That's not telling you anything you didn't already know from looking at the chart. But as the rally continued, the momentum was getting a bit tired looking in this region here, despite the big rally, of course. Now, obviously rallies do top out, and in this case it topped out here with this sort of momentum reading. Now, the profit takers came in and new short sellers came in, forced the price down, but then we had another rally to slightly higher high than this high here. There's a few ticks in it, But look at the momentum. The momentum only reached to this figure here, which was slightly underneath this level here. So because a new high was made over this high, but this high in momentum did not exceed this high here, we call that a negative divergence in momentum, negative momentum divergence. This is a warning sign that the rally has run out of steam and we should expect at least some sort of pullback. And of course we got an absolute beaut of a pullback down here. Now what happens in this region here is very interesting. It's and of course you can only say this in hindsight really, or just after say this top has been made, that the buyers who were long from down here were taking profits, of course. New short sellers were coming in, and that was overwhelming any buying interest that came into the market. And of course a lot of stops were placed under this point here. This is a very significant point. This is what I call the valley between the two highs. You don't always get that, by the way, but if you do, it's a wonderful place to enter short positions, because if you placed your stop just underneath this level here, you would have got stopped right in and you were away to the races down here. Now, as I say, you don't always get a valley like this, but at a top, I should say, or even at a bottom, but when you do, it's well worth exploiting. Okay, so most of the time momentum is just following the market. So really I hardly pay attention to it under those conditions. It's only when we get to extremes of movement, and following this plunge here, we had a big plunge down. This is when I start getting interested in looking at the momentum as it came down to very oversold conditions. Now these are the reverse of the overbought conditions. We had a plunge down here, we had a slight rally and a new low put in there, and then it rallied from there. Now the momentum, I don't know whether you can follow this, was corresponded to that point there. Then we had a rally and a move to a new low, but look at the momentum. It was way above this level here. So even though we had a new low on this point here, we did not make a new low in momentum. That is a positive momentum divergence. Positive in the sense that we're looking for positive gains in price. And of course, a negative momentum divergence up here, we're looking for a negative move in price, in other words, down. That's really the meaning of the positive and the negative, I think. And sure enough, we got a very nice rally up here. So there again, entries at that point there, although we had a bit of a pullback here, it still managed to make that rally. Okay, now let's follow along the chart from this point here. We're getting a rally from very oversold conditions, and it rallied up to this point here. Now look at the momentum, very, very high. Now that's again overbought. In fact, it's higher than these points here, even though the price point, the high here, is lower than the market up here. So right away we should suspect a turnaround somewhere around this. When the momentum is at this level, a turnaround is in the cards, not guaranteed by any means. In fact, momentum can stay overbought for a long period. We need other methods, and of course I'm showing you these in my other tutorials that I use. So there again, we had a valley, we had a rally up here. It did not make a new high, but that's okay. We can still use our method for entry by setting sell stops in here and getting in here. There again, we had another challenge, but then again it just overcame that and then plunged down here. Now looking on the longer term is a very good example here. We had a low, a very good low here on this momentum here. Well, this area, this whole area had the lowest momentum here. We had the rally back down to make a substantially new low from this low here, and yet look at this momentum. It did not make a new low from that point there. So that's a positive momentum divergence right there. Expect a rally from this point, and sure enough, we've got a massive rally. But there again, we've got a rally up to quite a decent, not an overbought, I wouldn't say, overbought reading up here. But as the rally progressed, which was a very strong one in price, look how weak it was internally. It never reached this sort of height here. So right away, you would suspect that this rally would eventually run out of steam, and it obviously did in this period here. Okay, now combining these ideas with the Elliott waves and the Fibonacci methods and the charting techniques that I'm showing in my emails should give you a pretty good arsenal for pinpointing entry and exit trades. In other words, exit trades, if you were shorting up in this area here, you'd be looking to cover, in this area here because of this divergence here. All right, well, that's it for now. Good luck with your trading, and I'll see you in the next video.